Hi everyone, hope all are fine. Today we made a video on Ind AS 1 presentation of financial statements. Ind AS 1 is a basic standard which prescribes the overall requirements for the presentation of financial statements and guidelines for their structure. Myself Bhargav, let's go to today's topics for discussion. Our discussion has been divided into 5 parts. Number 1, scope and definitions. Number 2, purpose of financial statements. Number 3, complete set of financial statements. Number 4, general features of financial statements. Last one, structure and content. Let's go to each topic in detail. Our first topic, first part, scope. Ind AS 1 applies to all types of entities, but it does not apply to structure and content of condensed interim financial statements. Uses terminology that is suitable for profit-oriented entities, so not-for-profit entities may need to amend the terminology if necessary. Then similarly, entities that do not have equity and entities whose share capital is not equity may need to adapt the financial statement presentation of members or unit holders' interest. Our first topic, second part, definitions. First definition, general purpose financial statements. These are those intended to meet the needs of the users who are not in a position to require an entity to prepare reports tailored to their particular information needs. Number 2, impracticable. Applying a requirement is impracticable when the entity cannot apply it after making every reasonable effort to do so. Number 3, Indian accounting standards. Indian accounting standards are prescribed under Section 133 of the Companies Act 2013. Number 4, material. Information is material if omitting, misstating or obscuring could reasonably be expected to influence the economic decisions of users. Fifth one, notes. Notes contain information in addition to that presented in balance sheet, statement of profit and loss, other comprehensive income, statement of changes in equity and statement of cash flows. Number 6, owners. Owners are holders of instruments classified as equity. Number 7, profit or loss. Profit or loss is the total of income less expenses, excluding the components of other comprehensive income. Number 8, reclassification adjustments. These are amounts reclassified to profit or loss in the current period that were recognized in other comprehensive income in current or previous period. Number 9, total comprehensive income. Total comprehensive income comprises of all components of profit or loss stated in number 7 and other comprehensive income, which will be discussed next. Last definition, other comprehensive income. Other comprehensive income comprises items of income and expenses, including the reclassification adjustments that are not recognized in profit or loss. Our next topic, purpose of financial statements. The purpose of financial statements is to provide information about financial position, financial performance and cash flows of an entity that is useful to wide range of users in making economic decisions. To meet the objective, financial statements provide information about an entity's assets, liabilities, equity, income and expenses including gains and losses, contributions by and distributions to owners, then cash flow information and notes to financial statements. Next topic, complete set of financial statements. In order to meet the purpose of financial statements, Ind AS 1 provides a list of what should be included in complete set of financial statements. It must include a balance sheet for the period, a statement of profit and loss for the period, a statement of changes in equity, a statement of cash flows, notes comprising significant accounting policies and other explanatory information, then comparative information in respect of preceding period, and a balance sheet as at the beginning of the preceding period only when an entity applies an accounting policy retrospectively or makes a retrospective restatement of items or when it reclassifies items in its financial statements. Our fourth topic, general features of a financial statements. First feature, fair presentation and compliance with Ind AS. This feature is fulfilled when the financial statements are complied with all the requirements of Ind AS and the information presented must be relevant, reliable, comparable and understandable. These are qualitative characteristics of a financial statement. with all necessary disclosures as required by Ind AS. Second feature, going concern. Generally, financial statements should be prepared on going concern basis on the assumption that it will continue its operations for the foreseeable future. So, at the time of preparing the financials, management will assess the entity's ability to continue as a going concern by covering the entity's prospects for at least 12 months. If the financial statements are not prepared on going concern basis, then the entity should disclose the basis of preparation and also the reason why the entity is not recorded as going concern. Next feature, accrual basis. An entity shall prepare its financial statements except for the cash flows using the accrual basis of accounting. When accrual basis of accounting is used, an entity recognizes items of assets, liabilities, equity, income and expenses when they satisfy the definition and recognition criteria for those elements presented in the framework. Next feature, materiality and aggregation. An entity shall present separately each material class of similar items. If a line item is not individually material, it should be aggregated with other items either in those statements or in the notes. Next feature, offsetting. An entity shall not offset asset and liability or income and expense unless required or permitted by an Ind AS. Next feature, frequency of reporting. An entity shall present a complete set of financial statements including comparative information at least annually. Next feature, comparative information. An entity shall present comparative information in respect of the preceding period for all the amounts reported in current period's financial statements except when Ind AS permit or require otherwise. Comparative information for narrative and descriptive information shall be included if it is relevant. Last feature, consistency. An entity shall retain the presentation and classification of items in the financial statements from one period to the another period. Our last topic, structure and content of financial statements. Now let's see how the financial statement should look like according to the requirements of Ind AS 1. Number 1. Identification of financial statements. An entity shall clearly identify the financial statements and differentiate them from other information in the same published document. Ind AS applies only to financial statements and not to any other information contained in the annual report. An entity shall display the following information prominently: name of the reporting entity, whether the financial statements are of an individual entity or group of entities, the reporting date and reporting period, the presentation currency, and the level of rounding used in presenting amounts in the financial statements. An entity shall present appropriate headings for pages, statements, notes, columns, and the like. Next, general point. An entity often makes financial statements more understandable by presenting information in thousands or millions of units of the presentation currency. Next head under structure and content of financial statements is balance sheet. At a minimum, the balance sheet shall include the following items. Under asset side, we have to present property, plant and equipment, investment property, intangible assets, financial assets excluding amount shown under, investments accounted using the equity method, biological assets and inventory. Next, trade and other receivables, cash and cash equivalents. The last point, the total of assets classified as held for sale and assets included in disposal groups classified as held for sale in accordance with Ind AS 105. Under liabilities side, we have to present trade and other payables, next provisions, next financial liabilities excluding amounts shown under. Number 1. Liabilities included in disposal groups classified as held for sale in accordance with Ind AS 105. Then non-controlling interest presented within equity. Then issued capital and reserves attributable to owners of the parent. These may be come under asset or liabilities side. They are liabilities and assets for current tax as defined in Ind AS 12. Next, deferred tax liabilities and deferred tax asset as defined in Ind AS 12. These are the minimum line items to be presented under balance sheet. So all the line items presented in balance sheet must be differentiated between current versus non-current. Let's see that. Most entities preparing Ind AS financial statements are required to present the face of balance sheet, differentiating between current and non-current assets and between current and non-current liabilities. Differentiation provides useful information by distinguishing the net assets that are continuously circulating as working capital from those of the long-term operations. Next, it also highlights assets that are expected to be realized within the current operating cycle and liabilities that are due for settlement within the same period. So, what is an operating cycle? Operating cycle of an entity is the time between the acquisition of assets for processing and their realization in cash or cash equivalents. When the entity's normal operating cycle is not clearly identifiable, it is assumed to be 12 months. The definition is the base for identifying current or non-current asset or liability. Let's see current asset definition and identify what is non-current asset. Current asset. An entity shall classify an asset as current when the asset is cash or cash equivalent. It holds the asset primarily for the purpose of trading, or it is expected to realize the asset or intends to sell or consume it in its normal operating cycle. Last, it expected to realize asset within 12 months after the reporting period. So, any item which are not falling under current assets shall be classified as non-current asset. Similarly, on other side, current liabilities. An entity shall classify a liability as current when it expects to settle the liability in its normal operating cycle, or it holds the liability primarily for the purpose of trading, or it does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. Last one, the liability is due to be settled within 12 months after the reporting period. So anything not falling under current liabilities definition, all such liabilities shall be classified under non-current. Next head under the structure and content of financial statement is statement of profit and loss. First section, profit or loss. Under profit or loss, we need to present revenues, gains and losses arising from derecognition of financial assets measured at amortized cost. Next, finance costs, impairment losses determined in accordance with Ind AS 109. Then share of the profit or loss of associates and joint ventures accounted for using the equity method. Then gains and losses arising from financial asset reclassifications. Next, tax expenses, and last one, a single amount for the total discontinued operations. Next section, other comprehensive income. Under other comprehensive income, we need to present two heads, that is other comprehensive income reclassified subsequently to profit or loss, then other comprehensive income not to be reclassified subsequently to profit or loss. The total of profit or loss and the total of other comprehensive income both must be attributed to parent of the owners as well as non-controlling interest. Next head under structure and content, statement of changes in equity. An entity shall present a statement of changes in equity which includes all changes in equity. The statement of changes in equity includes the following information. 1. The total comprehensive income for the period, showing separately the total amount attributable to the owners of the parent and to non-controlling interest. Number 2. For each component of equity, the effects of retrospective application or retrospective restatement recognized in accordance with Ind AS 8. Number 3. For each component of equity, a reconciliation between carrying amount at the beginning and at the end of the period separately disclosing each changes resulting from profit or loss, each item of other comprehensive income, and contributions by and distributions to owners, and last any item recognized directly in equity. Next head under structure, statement of cash flows. An entity should present a statement of cash flows in accordance with Ind AS 7 statement of cash flows. So we will cover under Ind AS 7. Last head under structure and content is notes. The notes shall present information about the basis of preparation of financial statements and the specific accounting policies used. Then disclose the information required by Ind AS that is not presented elsewhere in the financial statements, and disclosure of accounting policies applied, sources of estimation uncertainty about the assumptions made concerning the future, then entities, objectives, policies and processes for managing capital, then disclosures on puttable financial instruments classified as equity. An entity must disclose the amount of dividends proposed or declared, then other disclosures required by other Ind AS. Now let's recap what we have discussed today. Scope and definitions, purpose of financial statements, complete set of financial statements, what are general features of financial statements, and how the structure and content of financial statements should be presented. In case of any doubts, please comment below. Thank you so much guys.